7-Eleven is closing 645 stores. That's the biggest single-year contraction in company history, and it's happening while a buyout offer worth $46 billion sits abandoned, a delayed IPO gathers dust, and the founding family's own rescue plan collapsed before it ever got off the ground. Something has gone seriously wrong at the world's largest convenience store chain, and it didn't happen overnight. For most of its existence, 7-Eleven felt untouchable. Over 85,000 stores worldwide. More US locations than Circle K and Speedway combined. The orange, red, and green stripes are practically wallpaper in American life. A place you go without thinking, for gas, a Slurpee, a pack of cigarettes at 2 in the morning. That kind of ubiquity is supposed to be a fortress. Instead, it turned into a target. The first crack showed up in 2024. Alimentation Couch-Tard, the Canadian company behind Circle K, walked in with an offer. Roughly $39 billion to buy 7 & I Holdings, the Japanese parent company that owns 7-Eleven. 7 & I said no. They called the bid opportunistically timed and said it grossly undervalued the company. Fair enough. Companies reject offers all the time. But Couch-Tard did not walk away. They came back with more. $47 billion. And that is when things got strange. 7 & I didn't want to sell to Couch-Tard, but they also weren't exactly thriving on their own. So the founding Ito family, descendants of the man who built this empire from a single shop, tried something dramatic. A management buyout. Take the company private themselves for an estimated $58 billion, just to keep it out of Couch-Tard's hands. It was bold. It was also a bluff that got called almost immediately. The family needed a financial partner, and they thought they had one, Itochu, a major Japanese trading company. Then, in February 2025, Itochu walked. No financing, no deal. 7 & I's shares dropped nearly 12% in a single day, the sharpest one-day fall the stock had seen in over a decade. The family's rescue plan didn't fail quietly. It failed in front of every investor watching. You'd think that would hand the deal right back to Couch-Tard. For a while, it looked like it might. But 18 months of negotiations later, in July 2025, Couch-Tard did something almost nobody expected. They pulled out too. Not because the price was wrong, but because, in their own words, there had been a persistent lack of good faith engagement. Translation, they didn't feel like 7 & I was actually trying to make the deal happen. 7 & I disagreed, called the exit unilateral, and said they were surprised. But their stock didn't seem surprised. Shares fell as much as 9.6% that day, and months later, they were still sitting around 24% below what Couch-Tard had offered. Think about what that means. A $46 billion buyer walks up to your door, offers to take the whole business off your hands at a premium, and after a year and a half of back and forth, walks away frustrated. And your own stock, the one thing that's supposed to reflect what the company's actually worth, doesn't bounce back. It just sits there, quietly telling you the market thinks Couch-Tard might have had a point. So 7 & I pivoted. New CEO. Stephen Dacus, the company's first non-Japanese chief executive, formerly of Walmart Japan, stepped in to replace Ryuichi Asaka. And Dacus had a plan. Sell off the weaker pieces of the business, the supermarkets, the non-core retail, and double down on what actually works. Convenience stores, specifically 7-Eleven in North America. 7 & I had already agreed to sell its superstore business to Bain Capital for roughly $5.4 billion, and the plan included an IPO. Spin off the US and Canadian operations, list them on a major American exchange, and use the combined proceeds to fund a 2 trillion yen share buyback program running through 2030. On paper, it was a clean story. Cut the fat, focus on the core, reward shareholders. Except the core wasn't doing so well either. Here's the uncomfortable truth. 7 & I admitted in its own reporting, consumer spending had started to soften, especially among lower-income households, as inflation kept chipping away at what people had left to spend. That matters more for 7-Eleven than almost any other retailer, because 7-Eleven's core customer isn't shopping for luxury. They're grabbing a coffee, a hot dog, a tank of gas on the way to work. When those customers pull back, they don't switch to a cheaper 7-Eleven purchase. They just stop showing up. And they did stop showing up. Foot traffic declined, same-store sales dipped. Fuel sales, which used to be one of 7-Eleven's steadiest revenue streams, deteriorated further as market conditions shifted. This was the 5th consecutive year that 7-Eleven closed more North American stores than it opened. 474 closures one year, 373 the next. Now 645 in a single fiscal year, more than the previous 2 years combined. The company's answer was to change the format entirely. Instead of the familiar small box convenience store, 7-Eleven is now betting on something bigger. Roughly double the size, food-focused, with seating for up to 20 people. Think less grab and go, more sit and eat. Of the 645 closures, roughly 350 are being converted into wholesale fuel outlets, essentially gas stations without the full retail experience, while another 390 are being handed off to franchisees, and 205 brand new large format food stores are opening to replace hundreds of the old ones. It's a real strategy, and there's early evidence it's working. These new food-focused stores are reportedly generating 18% higher average sales than the system-wide norm. Merchandise sales inside 7-Eleven stores actually turned positive for the first time since 2023, driven largely by fresh food, even as fuel sales kept sliding in the background. But strategies like this take years to fully play out, and 7-Eleven doesn't have the luxury of years. It has quarters. Investors watching every earnings call for signs, the turnaround is real, and getting mixed signals every time. It's not just North America, either. While the US business is contracting, 7-I has been trying to expand somewhere else entirely, overseas. The company has set a goal of operating in 30 countries and regions by 2030, up from 19 today, with Europe positioned as a new growth pillar alongside the US and Australia. That ambition hit its own wall this year. In July 2026, 7-I ended talks over a potential investment in Zabka Group, Poland's largest convenience store operator, after failing to reach terms that served shareholders. The stock dropped again on that news too, down as much as 2.3% in a single session. Another door that opened, and then quietly closed. Which brings us to April 2026, and the announcement that really stung. The USA IPO, the centerpiece of Dacus's entire turnaround plan, the thing that was supposed to prove 7-Eleven could stand on its own without Couche-Tard's money, got delayed. Not by a few months. Pushed from the second half of 2026 all the way to fiscal year 2027 at the earliest. The stated reasons? Volatile market conditions, geopolitical tensions driving up energy prices, and frankly, the business itself wasn't ready yet. Dacus was blunt about it. The company needed more time to actually fix what was broken before trying to sell investors on the story. As he put it, 2026 was supposed to be about executing the transformation. If it worked, it would fundamentally change the business. The delay was an admission that it hadn't worked yet. Not fully, not on the timeline anyone had promised. 7-I stock dropped again on the news, down as much as 4.6% in a single session, trading at roughly a 20% discount to the price Couche-Tard had once offered. And by that point, the pattern was impossible to ignore. Every time 7-I tries to prove its standalone future is bright, something forces a delay, a reversal, a retreat. The Ito family's buyout collapsed. Couche-Tard's acquisition collapsed. The Zabka investment collapsed. Now the IPO, the last big remaining lever to unlock shareholder value, has been pushed back a full year. For the year overall, 7-I's shares were down roughly 6.5%, badly lagging Japan's broader market. There's a phrase one analyst used that sticks with you. The delay is almost certainly the right call, but time is running out. That's the tension sitting at the center of this entire story. Every individual decision 7-I has made looks defensible in isolation. Reject an undervalued bid, try to protect a family legacy, fix the business before you sell it to the public. Each one reasonable, but stack them together and you get a company that spent nearly 2 years in a holding pattern, watching its stock lag the broader market while competitors keep moving. Circle K keeps expanding. Regional chains like Wawa and Casey's General Stores keep proving that the food-first, fewer but bigger model actually works, without any of the drama. So where does that leave 7-Eleven? Not dying. Not close to it. It's still the biggest convenience store chain on Earth, and the new food-focused format shows genuine signs of life. But the version of 7-Eleven that used to feel untouchable, the one nobody thought twice about challenging, that version is gone. What's left is a company mid-transformation, betting its future on bigger stores and better food, while closing hundreds of the small ones that built its name in the first place, and watching deal after deal fall apart along the way. Whether that bet pays off depends on something 7-Eleven can't fully control. Whether the customers who've been quietly disappearing decide to come back before the next round of store closures gets announced. The convenience store king isn't fighting off one rival anymore. It's fighting to convince the market it still deserves the crown. Subscribe to the channel and like the video. There's a lot more coming.